More than anything else, there's one factor that'll determine if you're successful. Whether you trade stocks, crypto, or forex, how you manage risk is the single most important factor whether you blow up your account or you make a lot of money in the long run. But what is risk management? On the one hand, there's the obvious answer you've heard about in other videos. The most basic idea is we're trying to protect our capital and keep us from losing too much on any one trade. If you want to be entertained and see what happens when you don't manage your risk, check out Wall Street Bets. You'll see everything from regret to rage, panic to puking.
But anyway, let me show you this strategy. As you can see, this stock, I've been looking at this for a long time. It tried to go above $1, but when it did, boom, skyrocket jump. See, right now it's about, and it even go above $2. That means this stock at the end of this week or maybe today, it have chance to go to $5. So what I do is I put about 20 grand of share, about $2 right here. This one I got in, I believe, yeah, $2.
Wait, you put 20,000 shares in?
20,000 share of $2, so that's about $40,000.
40,000. Man, why would you put that much in there?
Man, that's all I got, man. I gotta say, because you know, my grandfather say, you want to be rich, you want to get successful, you gotta take a risk sometime. And my grandfather never lose.
Stock doubles from $1 to $2, and he thinks it's gonna go to $5 in a week, maybe even 5x in a day. He buys $40,000 and his friend asks him why he bought so much. He says, because that's all the money I've got. According to his grandfather, you can't get rich or be successful without taking a risk, and yet his grandfather's never lost. Sounds a little questionable expecting to magically double his money in a day, but what could go wrong?
Oh, man, you need to be.
Oh my, hold on.
Let me zoom in.
I did not do the stop loss. I was too exciting to do the stop loss. What is happening to me, man? I lose half of my money. It was at $2 something not long ago. Now it's like 99. No, 106.
Why am I not surprised? He didn't even use a stop loss. Was just so excited and think about all the money he was gonna make. And like that, half his account is gone. In this video, you'll learn what I wish I knew when I was first starting out. I've blown up multiple accounts and lost thousands of dollars. If you take the lessons to heart, you can shorten years off your learning curve. On the screen, I have 12 ads. They're obviously trying to sell something in one shape or another, but there's one thing that irks me about all of them. Pause the video, look over them all, and try to figure out the one lie they all have in common. A few of them are just ridiculous. Out of all the indicators out there, this is the only one that works in real time. I'm sure for the low price of $97, you can buy your very own crystal ball. All you have to do is wait for two magical lines to cross and you're guaranteed to print money. Or even better, these two in the corner. You don't even need to be at your computer to watch a real-time indicator. Just buy their crypto trading bot and you can make money while you sleep. So coming back to the question of what's so bad about all these ads, you might think it's the $500. I don't actually have an issue with that. Most traders lose, but there's plenty of traders who make $100K a year. I can let that one slide. What else do you see in every one of these ads? It's not that they're promising you can make $500 that's unrealistic. They're selling you on the idea that you can make $500 every single day with their easy strategies. Unfortunately, there's scam artists out there who will tell you anything you want to hear, promise you the world, and take advantage of your desire for steady income. The truth is, this is not an activity where you get paid by the hour to sit and trade. Some days the market's choppy. Don't be surprised if you end up with less money than you started with. I hope I'm not the first one to tell you this, but make no mistake about it. You will have losing days. There's no way around it. If you have the mindset that you have to make $500 every single day, you're on your way to blowing up your account. Before I started trading, I used to play a lot of online poker, and this was my attitude. I had to win every single day, no matter what. Some sessions I'd be up a few $100s in the first hour and I quit while I was ahead. But if I was down, that's another story. I'd sit there all night until the sun came up, trying to get back to even. Sometimes it worked, but other times I was much worse off than when I started. I'd get frustrated, tired, I'd move up in stakes, chase after hands, hoping for a lucky streak. I've had one bad session wipe out weeks of profits. Let's see how this exact same thing can happen in the markets. Pretend Timmy the Trader is determined that he has to make $500 every single day, no matter what. This is yesterday's graph. Made steady progress throughout the day and hit his goal. Unfortunately for Timmy, he hasn't gotten any traction today, down $200 around 11:30 and break even for the next 2 hours. At this point, he's $700 away from his goal, starts to get impatient. Time is ticking. Instead of waiting for all the parts of a system to line up, he starts clicking through the charts, trying to find something that's good enough to get into. Have you ever gotten impatient waiting for a trade? I know I have. I used to see something that's close to an entry, but not quite. Maybe it's only a 1.5 to 1 reward instead of 2 to 1. But I think to myself, let's give it a shot. It's close enough. And instead of risking 2%, I bump it up to 5% to help me hit the goal faster. That's a slippery slope. 2 hours later, and look where Timmy finds himself. $800 in the hole and $1,300 away from being plus 500 on the day. So what does he do? He throws $1,300 on the next thing that looks decent. Trade fails miserably. And he only has an hour left, and he's more aggravated and desperate. If he's convinced that he has to make $500 every day, including today, he's going to gamble $2,500 on a Hail Mary and wipe out 2 weeks of profits in just a few hours. Other than having unrealistic expectations, one way to avoid this is by setting a daily stop loss. Now, before we get into that, the assumption I'm making is you're trading with money you can afford to lose. What that means is you haven't gone into debt to fund your account. You haven't deposited $500 on the 15th and you need to double it in 2 weeks to pay your rent. If you lose every penny, you can still keep the lights on, gas in your tank, roof over your head. If that's not true, I don't want you trading. 90% of traders lose, and if you have the added stress of financial pressure in a 2-week time frame, you're almost certainly going to be worse off than you started. With that said, let's get practical and figure out your daily stop limit. Think of a dollar amount that's typically in your trading account. Close your eyes and imagine you put on a few trades that didn't work out and you lost money. Fast forward to after the market closed. It's now 11 p.m. It's been hours since you stopped trading. The question to ask yourself is, what percentage of your account would you have to lose to make you sick to your stomach? You can't sleep, you're beating yourself up, and you can't wait for the markets to open up tomorrow morning so you can get all your money back. No one enjoys losing money. But for me, if I lose 5%, I go about my day like nothing happened, sleep like a baby. 10%, I'm annoyed. But at 15%, I'm nasty, giving everyone attitude the rest of the day. The number's different for everyone, but whatever number you came up with, divide it by 2, and that's your new daily max loss. So step 1 is thinking about a painful loss and dividing by 2. The second step you have to consider is the time frame you trade. If you're a scalper, in and out of a trade anywhere from a few seconds to a few minutes and place dozens of trades in a day, If you risk 2% of your account and lose the first 4 trades in the first 30 minutes, you might be over your limit and have to quit the rest of the day. In this case, it'd make more sense to only risk 0.5% or 1% per trade. You could lose between 7 and 15 trades in a row before you need to stop. On the other hand, if you're a swing trader who holds for weeks or months at a time, I have no problem if you have 5% locked into one position. If you're like me, who's in a trade for a few hours or a few days and may be in more than one position at a time, I think 2% is a good starting point. Wherever you fall on the spectrum, don't forget about what we talked about in video 2, setting a stop loss and why it's important to have specific rules beforehand. Because once you're in the trade, greed, fear, and emotional excitement can make you do something you'll regret later. In case you're unsure about how to calculate position size, I'll show you the easiest way. The chart shows a little uptrend, just closed above the recent high and we decided to buy. Click on the left here to long position. Click at the current price where we enter, drag our exit to below the recent low, and set take profit to 2.5. What you want to do now is double click on the red or green to bring up the inputs. Account size is 5,000, risk is 2, and set it to percentage. Click OK. Everything is done for you. That 67 is how many shares you'd buy. Count is $5,000. We're risking 2%, which means we're okay losing up to $100. Loss is how wide the stop is multiplied by the number of shares. In red by the arrow, it shows we're risking $1.49 per share times 67 is $99.83, so the math checks out. You think the stop is too tight and you want to move it lower. Slide it down, still getting at least 2 to 1. Notice the numbers update automatically. We're now going to buy 53 shares, risking $1.86 each, which also works out to 2% risk. Looking at them side by side, in both cases we lose about $100. However, the size of your stop loss directly affects your trade size and how much you win when you're right. When the trade goes your way, you make over $50 extra on the left. But there's also a trade-off. Occasionally there will be times when price just dips below your stop loss before turning around and hitting your take profit. On the left here, we would have lost the full $100, while on the right made $200. So 2.5 versus 2 to 1, there's really not a right or wrong answer. For me personally, over the years, I've learned to be more precise with my entries. I would rather make more when I'm right. I know I'll lose a few more trades with a tighter stop, but I'm okay with that. Maybe if you're just starting out, losing upsets you more and you want to have the extra cushion that 2 to 1 gives you. Either way, look at the break evens of both of these and realize you don't have to be right that often. We can lose 3 out of 5 trades, 60%, and still make money with either stop loss. Now, listen very carefully. If you don't get anything else from this video, pay attention and remember, losers add to losers. I've lost more money from this one mistake than all others combined. Here's how averaging down works in theory. In an uptrend and I get long. Unfortunately, I was wrong. I can either exit the trade for a loss or I can wait until price goes back up and get out at break even. I'm thinking to myself, it's already come down a lot and it might take a while to go all the way back up there. If I thought it was a good idea when it was more expensive, maybe I can just buy more at a discount. My average price would come down and I can get out at break even sooner. Chart keeps moving lower, but I'm getting stubborn and double my size again. Lucky for me, price turns around and I can exit here at break even instead of being at a loss and hoping price climbs all the way back up to the top. It sounds good in theory, but this is what actually happens. On the daily chart for NOV, a few pullbacks, but overall it's up 250% over the last couple of years. Let's say there's a swing trader or investor who loves to average down and buy the dips. He makes his first buy of 20 shares at $70.43. Gets a higher low, looks like the trend will continue and picks up 20 more shares. Makes a higher high and gets in at 82.46. This last buy at 72.96 seems reasonable. Turning on the fractals, we see it's making higher lows and it just tested the fib and found support. Overall, he's bought 80 shares with an average price around $74.80. So far, everything's justified. No major mistakes yet. Here's where things start to get dicey. Making a lower high, he happily buys more at a discount here. He bought it all the way up to 82, and now he adds on 20 shares at 66.97 and 20 shares around 63.70. Price keeps going lower, and he keeps adding on 20 each time. Maybe it wasn't meant to be, because price continues to crash, but he's averaged down the whole way. One silver lining in this mess is his average price has dropped over 23%, a full $14 per share less. Hopefully price can go up a little. He can get out at break even. Looks like it's working. Eventually what goes down should come back up again. He bought at 35, 36, and 38. And now price is all the way up to 42, which means he's actually in profit on his recent buys, which can help offset the overall hole he's in. Chart looks promising, been consolidating, and I could imagine price trending upward to 55 where he can get out and not lose anything. Unfortunately, market has other plans and NOV continues to drop. On the surface, it looks like his plan is working. From 74.75, he's managed to lower his average price all the way down to 47.13, a 58% discount. I wish it ended here, but that's only half the story. Average price is higher than the current price, so we know he's in the hole. But how much? The answer is over $11,000. Not to mention he started to invest in NOV in the beginning of 2011. Think about the emotional stress of kicking himself for 11 years for not getting out while he could, having his attention pulled in multiple directions and all the lost chances where he could have used his money on better trading opportunities. If you think back 3 videos ago, what you'll realize is averaging down isn't some clever idea to get a better price. At the heart of it, the trader's looking for an excuse to convince himself that his idea is right. The message I've tried to hammer home over and over again in these videos is that losses happen. In fact, I frequently lose trades. Good ideas, they don't work out sometimes, and there's nothing wrong with that. What is wrong is staying wrong by not using a stop loss and getting out of the trade. The next thing I want to talk about as it relates to risk management is stock selection. Take a look at OCN. If you cover up the labels and just showed me the candles, I think this was a penny stock on a 1-minute time frame. Absolutely dreadful to trade. This is actually the 1-hour time frame, and look how many gaps there are. Even if your stop loss is set at 2% risk, there's going to be so much slippage by the time the order's filled. You might lose 5 or 10% when you did everything else right. Compare this with Cloudflare. No massive gaps or crazy wicks. The price action is much more predictable, and the volume will be there when you want to buy or sell. Unless there's a smooth flow between the candles on whatever time frame you trade, I'd stay far away from it. I'll show you a quick way to eliminate most stocks using a free stock screener. Links in the description below. On the home screen, go to Products, Screeners, Stock. We have almost 15,000 matches to start with. With just a few clicks, we can eliminate 90% of the junk. For exchange, we don't want any over-the-counters. For me personally, I don't want any micro cap, small cap, or the lower mid caps. I want to see companies with a cap of 3 billion or more, average 10-day volume at least 1 million, and I don't want to see anything under $5. If you click on technicals, you can filter by whatever your favorite indicators are. For example, if you only want to see stocks that are above the 20 EMA, choose EMA below price. You can filter only for stocks where the 20 EMA is above the 100 EMA. Your imagination is the limit when it comes to filtering. Even without using any technicals, I've eliminated 90% of the stocks and have 758 matches to choose from instead of 15,000. Another part of risk management is how related stocks are to each other. It's not often talked about, but if you have multiple positions open at the same time, you could be taking on more risk than you realize. Say you have a 2% risk on Apple and you also have a 2% risk on Microsoft. If you think about it, many of the factors that affect one technology company also affect the other. Whether it's a trade war, government regulation, computer chip shortage, all of these are built into the stock price. And what affects one tech company is most likely to affect the other in a similar way. In blue is Microsoft, and let's add Apple. The scale is a little different, but they're basically mirror images of each other. Highs happen on the exact same date. Same low, highs match up, bottom out the same day, and the pattern continues. So if you lose on your Apple trade, you're most likely going to lose with Microsoft. What you're basically doing is lumping them together and risking 4% instead of only 2%. Intuitively, we know Apple and Microsoft stocks move together, but let's put a number to it. Over the last 5 years, they had a correlation of 0.9757, which means these two stocks move together over 97% of the time. Unless I have a good reason, I try to avoid having multiple open positions with positive correlations of 0.8 to 1 and negative correlations -0.8 to -1. This website can show the correlations of 9 stocks at a time. Links in the description. Apple and Microsoft are obviously going to be related, but some matchups might surprise you. Look to the right of McDonald's. MCD versus CVS is 0.55, which is moderate, but everything else is above 0.8. When I think of McDonald's, IBM isn't the next thought in my head. I'm shocked to see they move together 92% of the time. Boeing Airlines, AT&T, and Chevron are all in different industries, and yet McDonald's has correlations ranging from 86 to 95 with them. Now look on the left, McDonald's is weakly correlated with these other 8 companies. Let's assume you own McDonald's already. Just to be clear, what I'm not saying is randomly buying shares in one of these companies on the left just because they're uncorrelated. Assume your trading system gives you 2 buy signals. I would be more inclined to diversify by adding ZTS instead of AT&T. This would give me a better chance to reduce portfolio risk by lowering volatility and improve overall risk-adjusted returns. Elder wrote, every winner needs to master 3 essential components of trading: a sound individual psychology, a logical trading system, and good money management. These are the 3 legs of a stool. Remove one and the stool will fall, together with the person who sits on it. The goal of the last 4 videos has been to touch on all 3 of these legs: psychology, trading system, and money management. If you missed any of these, full playlist is here. Video 1, the most common reason traders lose is because of psychology and their distorted views about winning and losing. The turning point for me was finding a study of 12 million trades and realizing I wasn't alone. At the core, we're all making the same fundamental mistake. Martin summed it up perfectly when he said, you have to master your ego and realize that being profitable is more important than being right. With a win rate of 60%, I expect to lose 2 out of every 5 trades. Losing money is inevitable. There's nothing I can do to avoid it. It's how I treat those losses that'll make all the difference in the world. In video 2, there's a reason even before talking about making money, I focused on what happens when your trades are losing. Everyone wants to think about turning a profit, but that video went over 3 rules for setting a stop loss, keeping the losers under control. Mark wrote, "Not losing big is the single most important factor for winning big." And I love how he finishes it. As a speculator, losing is not a choice, but how you lose is. In video 3, we talked about the ABCD pattern for cashing out and why you can actually go broke taking profits if done incorrectly. The main idea of this 4th video is profitable trading is not about avoiding losses. We're in the business of managing risk. It's not about making X amount every single day. Some sessions will go poorly, but having your daily stop limit in place will help you to live and fight another day. And above everything else, never add to losing positions and average down. It's the quickest way for things to get out of hand. I'd recommend rewatching all 4 videos and let it soak in. Check out the playlist here, comment below what you learned, and suggest ideas for a future series. Don't forget to subscribe. I'll see you in the next video.